Welcome to the InterMarket analysis video update. This is a video that I do every week, and if you watch these videos on a regular basis, there's really no changes this week. There hasn't been any changes for a while. We're still looking pretty positive. The idea behind this video is just to update the charts, let you see how things are behaving at this time. The market's setting all-time highs with the S&P, the Dow, the NASDAQ 100. Growth is outperforming value. Things are looking pretty solid, but on the daily side, especially, and a little bit on the weekly side, we're seeing some vulnerabilities. Plus, we're coming into a even more weak seasonal time. Now, I've been watching for weak seasonality going back to the middle of July. Didn't happen. August didn't happen. So far in September, hasn't happened. We'll have to see. Now that options expiration is finished for the month of September, that was Friday's session, we'll see if, in fact, there is some weakness that will come into the market. Right now, anyway, it doesn't appear that the market is becoming overly defensive at this time. If we do decline, it looks like that's what it will be, a decline. Not a reversal, we're not shifting the overall atmosphere. We're still looking positive, but at some point, folks are going to want to come in and take some profits. However, when you look at sentiment, which I don't go through in this video, I go through in other videos, there's still more room to run to the upside. You have a lot of disbelievers that the market should be going up right now. And if it continues to hold on to these gains and even see some more, they may want to jump in for the fear of missing out. Remember, fear and greed are always interacting with all investors. The fear of losing, the fear of missing out, greed, the fact that you're already seeing some good profits and you want to see even more, even when it's not necessarily prudent to hang on to a particular position. We haven't really seen any of those things kick in gear with any real conviction at this point. Okay, so this is being prepared for Monday, September 22nd. The first area that I'll go through is valuation. Been saying the same thing for years now. We're overvalued, whether you look at historical earnings reports or even if you're looking forward at projections and forecasts for what earnings will be. Then we look at growth versus value. Growth is still outperforming. We keep an eye on inflation. And there's one chart that's giving us a little bit of concern, but we're not necessarily seeing that confirmed on other charts. And then we look at some other markets that are outside of the stock market. And we look at the 11 sectors that make up the S&P. First, we look at the sector by itself. Then we compare it to the performance of the S&P. Then we look at a lot of different indexes, different correlations between different markets, some very long-term trends, mainly using monthly charts. And then at the very end, a positive negative list. I'll tell you again right up front, same thing I said a week ago. The list hasn't changed. Everything is positive except for the US dollar index. All right, so valuation, what we have seen now for quite some time. If you look at historical earnings reports that have come out, we would be right at about the red dashed line. That's the PE ratio of 20. Well, we're way above that, way above it. We would have to come down to the 4,300 level or so just to get back to being expensive. But you can see this has gone on for a long time. I also break it out down here, price compared to the PE 20 reading here, and just showing how we're becoming more overvalued. And typically what I say when it comes to valuation is it doesn't seem to matter until it does. So that pretty much makes it useless for us as far as a timing mechanism. If we really start going down, people will always look back in hindsight and go, well, yeah, the market was overvalued. Well, okay, there's other tools that you can use that actually can substantiate that type of a position. Then we also look at that same thing here, what the current price is for the S&P. These are the different valuation levels going back to 1980. This is Robert Shiller's take on that, where he looks at a smooth approach using earnings over a period of time. Man, we're really going up here at 39.95. That's a high reading just looking here at the chart. This chart goes all the way back into the 1800s. And then the median and the mean is 16, 17. We've been seeing that for a long time now. So yeah, we're getting quite overvalued here. And then this is the forward-looking PE ratio, where with the latest reading, on Thursday was that the mega cap 8, as measured by this particular chart, coming in at 30.2. So we're above that 30 threshold. But you see, we've been there before. And even when we've had declines, it's not like we come crashing down with the valuation. There are the earnings behind these companies to justify their optimism that they're going to go up in price in the future. Then we look at the S&P itself. That's the red line coming in at 22.6. We're above that 20 level and still coming in more fairly priced with the mid caps and small caps. The mid caps are at 16.2. The small caps are at 15.7. They're more fairly priced. And we're seeing, well, the Russell 2000 small cap index. What you see here is the S&P 600. That's another small cap index, and I track both of them. The Russell 2000 small cap set an all-time high this past week, surpassing the high that was set in late 2024. We're not there yet with the S&P 600. It still has a ways to go to get back to that high set in late 2024. Now we look at growth and value. First, we just look at growth, looking pretty solid all by itself. We look at value, which is also holding up quite well. But again, where we get our insight is when we do ratios between the two. The top chart shows how growth is outperforming value. The bottom chart shows how value is underperforming growth. And we look at some ETFs. Growth is outperforming value. Value is underperforming growth. Look at some indexes. Growth is outperforming value. Value is underperforming growth. Do you see a little theme going on here? And then this is another growth to value ratio, looking quite positive right now. Value to growth ratio, looking negative if you prefer value, but it's actually more positive for the market. And then we look at the small caps. Now, this is a little bit of a concern. We've been seeing a little bit more favor in the small caps here, even with the S&P 600. See, here's the high that was set back in 2024. We haven't come back up to that level yet. But as this index has been going up, we've been seeing the growth to value ratio going down. And I've been pointing that out a lot in the daily videos and in other videos, and we're still seeing it here. It bounced back up, but we're still below both of these moving averages right now. In a more positive environment, we want to see this ratio going up. Now, looking a little more healthy, but the mid caps aren't performing all that well, and they're not back to their previous all-time high either. But this growth to value ratio is actually looking a little stronger right now. S&P growth to value, not breaking down, but not showing a real sign of strength right now. The bigger picture is that we're still in an uptrend. It would be nice if we could get back above the 50-day moving average. When we hit August, this is when I kept saying the market looks like it's getting more defensive. Well, it hasn't really turned back offensive as far as this chart is concerned. There's other things that we can look at. This is just a growth to value ratio here. And the fact that we're going sideways, does that mean that there's going to be some kind of a pullback and that this isn't really leading and breaking out to the upside? Just a open-ended question to throw out there. Inflation. Now, this is the chart that's giving us a little bit of concern here. And this is a proprietary chart put out by Martin Prang, and he takes the inflationary areas and deflationary areas and does a ratio. But we're not really seeing this confirmed in other areas. The bottom chart here, it's a monthly chart, and we've been drifting down. Well, after we started working our way through 2025, we came back above the red line, and we're continuing to go up, and now the red line's turning back up. Now, we're not really seeing that in other areas, but this is a bit of a concern. We don't want to base everything around this, but we don't want to just throw this out the window either. Then on top, see where the CRB index, these are commodities longer term, not really breaking out to the upside. They are in an uptrend. They're above the moving average, and the moving average is going up, but not really showing any hyperinflation, at least at this time. This is a daily chart of the CRB index, kind of just chopping along, going sideways. Baltic Dry Index, it is in an uptrend. This is another gauge that we look at for inflation. In the general sense, when this is going up, that's more inflationary. When this is going down, that's deflationary. And inflation expectations, we're not really seeing the market freaking out about inflation right now. They're kind of holding where they've been before. And we're still kind of drifting down for the most part when we look at inflation expectations to tips, actually showing this ratio going down. Other markets, aluminum, still in a downtrend, but it's been bouncing back up. Corn in a downtrend and coming off of the lows here, maybe because we're getting into fall and it's corn season or something. but this has been bouncing up a little bit lately. Wheat is also continuing to be in a downtrend. Fertilizer coming down a little bit. We were a little bit concerned when this was going up. Now it's been retreating lately. Lumber, which is actually below both moving averages, not quite in a downtrend yet, but has been seeing some weakness. Oil, which I watch this for geopolitical reasons, we are drifting lower here. We're getting more into the low 60s. We look at an oil to 10-year yield correlation, neutral right now. We've been going up with oil. We've been going down with the 10-year yield according to this chart. And this measures, okay, are they going in the same direction? Then we would get a high reading. Are they going in opposite directions? Then we would get a very low reading. Well, we're getting a neutral reading right now. Gold to oil. And it's not that oil's been going up, is it gold's been going up here, and that's been helping this ratio to rebound a bit. And gas still in a downtrend, just seeing a recent death cross here and with a price dropping below the moving averages. Heating oil is actually starting to get more into an uptrend, but longer term, it's been in a downtrend. Natural gas is in a downtrend right now. Diesel, it started to go up, it fell back. Now it seems to be leveling out here a little bit. And then copper, we're still underneath both moving averages here on the daily chart, but we're hanging on to being in an uptrend. And this is a barometer of the economy, and we're seeing this starting to go back up, going back to the beginning of July or so. And that's better because it got really hit after some tariff news came out. It just wiped out copper there for a while. But this going back up is more positive for the economy, but we're still seeing the copper to gold ratio going down. And we also see the copper to gold ratio longer term here going back to 1980. That's going down. We're also coming down here with the 2-year yield and the 10-year yield as well. And gold, not at highs right now, but just set recent all-time highs this past week, where we do have silver setting an all-time high in Friday's session. We look at a gold to silver ratio, and this is going down. That means silver is outperforming gold. And then we compare that to the US dollar index, well, neutral right now, not really getting any insight there. Now, the weekly video shows that we're in a downtrend with the US dollar index. Here on this video, we're seeing on the daily side that the dollar is also in a downtrend. And this shows how the euro's been going up as the dollar's been going down. Also added here is the Japanese yen, which has really been chopping around sideways lately. And we look at the Japanese yen to the dollar, which is going sideways, but still in an uptrend, but not really showing any strength lately compared to the dollar. Where we're seeing more strength here is the euro to the dollar on this chart and the pound, the British pound to the dollar. Not really breaking out, but going up nonetheless compared to the dollar. Then we look at the S&P weighted version versus the equal weight version. We went up with the S&P in Friday's session, down a little bit with the equal weight version. But for the most part, these are sticking pretty close to each other, but we're still seeing the S&P 500 having a tendency to outperform. And that's because they're the really big stocks. It's a weighted index. And when you have Google and Apple and Microsoft and all those companies really going up, they have more of an impact on the S&P 500. Just if they're going down, they have more of an impact too. So we're still going down overall when we compare the equal weight to the weighted version of the S&P. Stocks to commodities, again, we're not really seeing anything here inflationary. Stocks are outperforming commodities. And then this is an inverted version of that same thing, showing how commodities are underperforming stocks. So we're not seeing anything on the daily side. I'm not really seeing anything on the weekly side. It's that one inflation deflation ratio that seems to be giving us a warning sign that inflation's picking up, but we're just not really seeing it in other charts that I follow. And then we look at the NASDAQ 100, which is outperforming the S&P. They're both setting all-time highs, but the NASDAQ 100 has even been outperforming that. And the S&P 100 is outperforming the S&P 500. We're still seeing where the NASDAQ 100 is underperforming the rest of the NASDAQ. That continues to go down, which you could take that as positive. When this is going down, that means the NASDAQ is outperforming, and that's a broader measure of mainly tech. And so that just means there's more broad participation. Then we look at the NASDAQ, which is also outperforming the S&P 500. Mega cap growth, this is the real backbone of the stock market, continuing to go up and set new all-time highs and in a pretty solid uptrend. Also outperforming when we do a ratio between mega cap growth and the equal weight index. We had fallen back down here in August, which this was causing us a little bit of a concern here We came back down to the 50-day moving average, but since then we've been bouncing back up. And we look at the robotics and AI ETF, looking pretty positive here, but still having a ways to go to get back to the previous high set back in 2021, and still underperforming when we do the robotics and AI ETF with the tech sector. And small caps, even though they're seeing some favor now, they've got a long ways to go to start to outperform. This shows the red line is the ratio between the small caps and the S&P. That's going down, even though it's been bouncing back up lately. And the blue line, that's the S&P itself. And you can see where they've been going in opposite directions, pretty much going back to 2021. And then small caps versus the tech sector. Even though small caps are doing good, tech's been doing even better. So that's why we're seeing this drifting down. The Dow Jones Composite Average, which is the Dow, the transports, and the utilities, positive, not quite back to the previous high. Low volatility, just continuing to go sideways right now. These are more defensive areas, but this is more encouraging. When this is going down the way it is right now, that means the low volatility ETF is underperforming the S&P 500, and that's more positive. And we're seeing an improvement here, but not any real consistency with the semi to tech ratio. We broke out on Thursday and then we came back down on Friday. But this is doing okay, and semis are doing okay, tech's doing okay. But when the market is really, really strong, like at the beginning of 2024, we see this ratio outperforming. It's not really taking a leadership role right now. Then we look at all the stocks in the world, but take out US stocks, looking pretty solid here, setting all-time highs. Then we put US stocks back into the equation. Yeah, not doing so good there. Still suggesting that US stocks are underperforming world stocks. Energy sector is underperforming the tech sector. That's why this ratio is going down. Growth is still outperforming bonds. And the tech sector is outperforming the 10-year yield. The 10-year yield is underperforming the tech sector. Discretionary is outperforming staples, and this area has been showing some recent strength lately, and that's positive for the market. Staples, which are more defensive, are underperforming discretionary. Gold has been doing well, just coming off of all-time highs, and the S&P's been doing really well, setting all-time highs. So we're not seeing much gyration lately with this overall ratio, but with the dollar going down and gold going up, we're seeing this ratio really going up. Then we look at the advanced decline line across multiple indexes, the NYSE common stock, and we were up on Friday, but see how this came down, but we're still above the moving average. We actually declined a little bit with the S&P 500. We're below the moving average with the mid caps and the small caps. A little bit of weakness under the surface there that we're keeping an eye on. Now, we did set an all-time high with the Dow, but that was not confirmed by the transports. We did set a high right at the beginning of August with the utilities, but we haven't been able to come back to that. This is more of a non-confirmation according to traditional Dow theory. And we look at the Dow, which is outperforming the transports. Here are the transports, which just don't seem to be able to sustain any kind of an upward move over the last few months. In fact, the S&P has been going up. The transports have been going sideways at best, and we see that their correlation is not very strong right now, and also underperforming the S&P 500 when we compare the transports to the S&P. This ratio started to decline in 2023, and it's just been, you could even go back into, well, yeah, earlier 2023, and you can see how they continue to underperform. Now, we are setting a new high here with the S&P. We're setting a new high with the NASDAQ. Now, we're not quite back to an all-time high here with the S&P equal weight, but we did set an all-time high with the QQQ. That's the NASDAQ 100 equal weight. Now, you could see this as negative, meaning that the S&P equal weight is not confirming the QQQ equal weight. Or you could see it as positive, saying, well, this is tech, and these are the big stocks, so they're just leading, and we're going to go up and actually set a new all-time high soon. We don't know the answer to that. There's just different ways of being able to look at this chart and interpret it. FANG index, the really big stocks, setting an all-time high. The Wilshire, a broad market measure, setting an all-time high. Total U.S. stocks, setting an all-time high. In an uptrend here with ARC, NYSE composite just coming off of an all-time high and in an uptrend. High leverage loans, another barometer of the economy, still looking pretty solid here. All stocks looking pretty good, U.S. and international. Microcaps doing well, but not quite back to recent all-time highs, but not that far away either. The SMH Semiconductor ETF, now this did set a new all-time high on Thursday. It was down a little bit on Friday. And this is that same thing, but just showing you with a rainbow how it's breaking out. Now, this is showing a little bit of leadership. And we're doing okay here with the AI tech ETF. This is different than the robotics and AI ETF. This one is looking stronger. Emerging markets looking really good, actually starting to set a new all-time high here. The Japanese Nikkei index just either at or near all-time highs. Bitcoin just kind of moseying along its 50-day moving average. And then we look at the S&P home builders, and we're seeing that the top chart and the middle chart are showing a pretty strong correlation. And we're starting to see an uptrend develop here with the KST back in China, emerging markets. Europe is turning up, but hasn't turned to an uptrend yet. We're trying to turn up in Japan, and we're starting an uptrend here in the US. So this is longer term, and this means that there's the possibility anyway of more upside potential. And this is a long-term chart of US to world stocks, still above the moving average. We're still going up here longer term with the PPO momentum oscillator. Looking at bonds here based on price. We came up here. When we see these two top areas here, that's right around 4% for the 10-year yield. And we bounced off of that twice, and now we're starting to come back down. As this goes down, that means interest rates are going up. If this continues to fall, that could put some pressure on stocks. Total bond ETF, though, is in an uptrend based on price. Stock to bond monthly chart showing stocks outperforming. Daily chart showing how bonds are underperforming stocks. The Pring World Bond Index just kind of chopping around here, but it is positive. And then high yield bonds, which are junk bonds, setting all-time highs. Corporate bonds just coming off of setting all-time highs. And the stock to bond correlation, we're actually coming back down into more neutral territory. Usually they have a tendency to go in the same direction lately. And this is just showing, again, I show this every week, that how we're establishing a higher range, which is much different than what we had been seeing over the last 40 years. Investment grade bonds like corporate bonds, they're looking pretty solid still. Here's another look at the junk bonds coming off of all-time highs. And we're looking at the junk bond to government bond ratio here. We're still seeing overall how junk bonds are outperforming, even though we did come back down to the moving average with this ratio. Riskier versus more conservative bonds, just kind of going along sideways, not seeing any real outperformance, but not seeing any real underperformance either with the ratio. And this is just a daily chart where we were coming down with all of the different yields. And then the last couple of days, it started to go back up. This is what we're going to be keeping an eye on. We're also watching this red line in here, which is the 10-year yield for Japan. If that continues to go up, it was in August of 2024 when this went up and it caused some real problems that lasted a few days. If this continues to go up, are there going to be more problems that might cause? And we look at some stock to bond ratios here. The S&P 500 to 1 to 3 year bonds, stocks are outperforming. This is 3 to 7 year bonds compared to the S&P, showing how bonds are underperforming. S&P 1500 setting an all-time high when compared to the 1 to 3 year bonds. The broad market setting an all-time high when compared to 3 to 7 year bonds. The tech sector looking really solid compared to 3 to 7 year bonds. And we're really coming down here with the MOVE index. This measures the volatility of bonds. We've been under 20 and declining for the most part with the volatility of stocks. But you can see here their relationship is getting back to neutral. Is this suggesting there's some kind of a shift that could be getting ready to happen? Then we look at the stocks to the 10-year yield, showing how stocks are outperforming. Then a long-term chart here, the monthly UST, that's the long-term bond, trying to come back up to the moving average, but we're still down below the moving average. Then we look at another ratio of the long-term bond to commodities. This is continuing to go down. So it's not necessarily being confirmed by that inflation-deflation ratio that we saw at the beginning. Different sectors, materials still kind of humming along their 50-day moving average and underperforming the S&P. Communications setting all-time highs and doing really well when compared to the S&P. Energy just seeing a recent golden cross here, but not really breaking out to the upside, and also underperforming when we compare it to the S&P. Financials doing well. We look at this chart all by itself, just coming off of all-time highs. But this is the concern. Going back to about Memorial Day or so, we started to see the financials underperforming stocks. We bounced back up, and now we're back down to underperforming again. Is this some kind of a warning sign? We've been watching this for months now, And so far, it hasn't really meant anything. We'll just keep an eye on this. We'd like to see this ratio going up. Industrials just humming along their 50-day moving average and had been outperforming the S&P 500, but since about July, we started to see this ratio really come down. And the tech sector, this is the big growth area, setting all-time highs and one of the more leadership areas here when we compare it to the S&P. Staples just humming along, going sideways, underperforming when we compare it to the S&P. Real estate humming along its 50-day moving average and really underperforming when compared to the S&P. Utilities looking pretty solid, still dealing with its 50-day moving average, but now back to underperforming when compared to the S&P. And then this is another S&P to utilities ratio. I had been using this chart a few times this past week. When this ratio goes up, that means the S&P is outperforming utilities. And then healthcare, which is just kind of dancing along. It's in a downtrend, but it's hanging around its 200-day moving average and really underperforming a defensive area here. Discretionary, improving. You see, back you go into May. Once we finally came up out of those lows after the dive we took in March and into April, it went sideways for a while, and then we started to go up. We fell back. If you go back to the beginning of August, this is where the discretionary sector really started to take more of a leadership role. And it's still in a downtrend when compared to the S&P, but it has been improving since the beginning of August. The SOX index, which was semiconductors, setting an all-time high. And we look at the semiconductors to Dow ratio, we're back up to the blue line. Dow Jones Semiconductor Index. Now, you remember the other semiconductor index, we were setting all-time highs. This is just off of setting recent all-time highs. And the intermarket analysis chart up over 40% with gold. We have stocks in second place. Commodities and bonds based on price are kind of equal with each other, where we have energy and the dollar, which are negative year to date. Correlations having a tendency to go in opposite directions when we look at stocks to the dollar. Now we're coming back up here and possibly turning more neutral. You can see as the stocks have been going up, the dollar's been going down, and we were seeing a fairly strong inverted relationship there. And the S&P 500 to oil had been getting stronger. Now it's working its way back to looking more neutral. And S&P to the 10-year yield having a slight tendency to go in the same direction. So S&P's been going up, the 10-year yield's been going up. And tech to the 10-year yield also going up with the 10-year yield, tech sector going up there. And then shorter term, stocks to the 2-year yield, we broke through the neutral area and we're having a slight tendency to go in the same direction. We've been going up with the S&P and lately we've been going up with the 2-year yield. Long term, a monthly chart of the NYSE looking really solid here, setting all-time highs, but the Copic curve is still going down. It rolled over right at the beginning of 2025 and it hasn't been able to turn back up yet. Then another monthly chart here, the NYSE, we're still going up with the NYSE record high percent index. Now we look at a monthly chart of the S&P, looking really solid longer term. We look at a momentum oscillator, the percentage price oscillator, that is in an uptrend. The S&P on top, and then a longer term S&P to the commodities ratio. You can see how this is actually going down. That means that commodities are actually outperforming, but now we're starting to turn back up. So you could say this is confirming that other chart a little bit, but not really overtaking it necessarily. And then US to world stocks still hanging out above the moving average, still declining with the longer term KST oscillator. All right, then here are all the positive things. And rather than just reading these off, I'll just bring them up here. You can pause this and look at it. It's not everything that I go over in this video, but these are just the main asset classes that I keep track of. And then the other one's really easy because it's just the dollar index that's negative here. Thank you. Have a great weekend, and I will talk to you in the next video.